afternoon, everyone. I'm Kellyanne Cerini, the Marketing Manager at Cerini and Associates, and thank you for joining us for today's webinar, where SterlingRisk will be covering a risk transfer overview, an introduction of the New York labor law, and more. I'd like to introduce today's presenters, insurance professionals, Josh Weisberg and Michael Fleischer of SterlingRisk. Guys, take it away.
Good afternoon, ladies and gentlemen. On behalf of Cerini Associates and SterlingRisk, we greatly appreciate you taking the time from your busy schedules to join us today. We will provide you with an overview of the New York labor laws and how they affect the construction and real estate industries. These laws have and will continue to negatively affect the landscape of the construction and real estate industries. I will provide you with a brief history and overview of the laws and how they have and will influence construction projects and real estate development. These laws are especially an issue within the 5 boroughs of New York City. My esteemed colleague, Josh Weisberg, will provide you with the following: an overview of risk transfer, the mechanics of the indemnity, hold harmless, and insurance provisions, and finally, an overview of additional insured coverages. At the end of the presentation, we'll hopefully have some time for questions and comments. Please hold your questions until then. If there's anything that's more in depth, our contact information is provided at the end of the presentation, and Josh and I will be happy to make ourselves available. Introduction to New York labor law. The New York State construction industry has been negatively affected by unique laws that go back to the 1880s. The results of these laws affect developers, general contractors, and trade contractors within the state of New York. New York's labor law, Section 240, first enacted in 1885 and revised over the years, imposed what amounts to absolute liability in most cases on property owners, general and subcontractors for accidents involving falls at construction sites. Other sections of the labor law, notably 241(6), also impose statutory liability upon owners and contractors for construction accidents. These sections of the labor laws have driven up the cost of construction and been responsible for higher insurance premiums that are well above any other state in America. Even though other states don't have labor law counterpart, the reality is that construction accidents lead to personal injury lawsuits in other jurisdictions as well. Meaning the exposures related to construction litigation are not exclusive to New York, and much of what we will discuss today is relevant in other states as well. And as an example of these laws, they're estimated to have added approximately $400 million in additional costs associated with the replacement of the Tappan Zee Bridge across the Hudson River. Contemplate that. That's just one project. Now multiply that by all of the construction projects within New York State that are public, as well as all the development within New York City. Imagine the cost to taxpayers and the effect to the real estate industry, the increase in these costs, okay? As claim settlements have risen well into the millions, the primary limits of general liability policies are frequently exhausted by claims. These claims now regularly reach into the excess or umbrella layers of owners and contractors' policies. This has resulted in excess carriers requiring higher limits on primary policies. Most carriers look for $2 million, $4 million, meaning a $2 million primary general, $2 million per occurrence, as well as a $4 million overall aggregate. For projects within the 5 boroughs, these limits are a requirement. In addition, many projects are requiring higher umbrella limits be carried by all entities involved with specific development projects. This increased limits and premiums being charged by carriers are creating a greater burden on contractors. The availability of reinsurance, which in essence is insurance for the insurance carriers, has become scarce, driving up pricing for these policies. In many instances, we're seeing the excess premiums dramatically higher. And in fact, in some cases, we've actually seen excess premiums that are higher than the primary general liability premiums. The figures that I've outlined on this slide are the impetus for the changes in premiums that we just discussed. You can take a look at these costs, and I apologize, the screen is on the other side here. You can see just by the size of some of the verdicts, if you look in 2019, there's a $102 million verdict that's out there. Please recognize that most settlements and verdicts are protected by non-disclosure agreements. Therefore, the figures that are shown here are really the tip of the iceberg. Okay, you can see by the average settlements as well as the range of settlements that these figures are skyrocketed. Underwriters and reinsurers never envisioned settlements this high. This has had a tremendous amount on a tremendous effect on the pricing and the availability of coverage for these exposures. Many carriers have adjusted their position to writing these exposures. As the most severe cases tend to be within the 5 boroughs due to the favorable juries for plaintiffs, many carriers have withdrawn from writing construction exposures in these areas. In fact, there are so few carriers that remain willing to write construction in New York City that it's become even more difficult to place coverage on these exposures. The carriers that remain willing to write these exposures are requiring changes be made to manage the exposures that are inherent in the construction process. To offset the adverse loss history from these exposures, carriers are focusing on safety and are requiring an increased focus on safety and loss control for all parties that are involved in construction processes. On larger projects, we've actually seen instances where carriers are requiring full-time safety personnel to be on site at all times. To sum this overview up, the effect of the labor laws and the construction accident lawsuits in state, back up a second. To sum this overview up, the effect of labor laws and construction accident lawsuits in other states to the property development and real estate industries have been and will continue to be significant. They've made the purchase of insurance much more difficult, more expensive, and all parties involved will be required to place much more focus on the management of the exposures inherent in the construction process. Insurers are also requiring the full review of all policies involved with regard to construction processes. That includes general contractors, subcontractors, as well as the developers. Policies must be reviewed as opposed to simple certificates of insurance, because certificates of insurance generally do not include all exclusions and or policy limitations. The actual exclusionary wording is sometimes buried within the policy language, stuck within relatively innocuous language. So therefore, it is crucial for all policies to be fully insured, fully reviewed. Okay, this is something that is a requirement for today. This is a quick overview of what you're seeing in the industry. And my colleague, Josh Weisberg, will now take an in-depth look at how to educate you and help you understand and better manage this process. Take it away, Josh.
Thank you, Michael. Very much appreciated. Before we kind of dive into how you manage the process related to exposures associated with the labor law and construction accidents in general, one of the roles that I have here at SterlingRisk is to assist with contractual drafting, which we'll talk about in a minute, but also I work on labor law claims every single day, all day, with the balance of my claims department here at Sterling. And just, a couple of extra data points in addition to what Michael was discussing. Post-COVID, and it's very important to understand this, post-COVID, what we are starting to see, both in terms of settlements of construction accident litigation, labor law claims, in addition to overall settlement values related to other forms of personal injury litigation, is these numbers are going up. We're starting to see victims or alleged victims of construction accidents and premises liability claims in general going for more surgical treatment, which drives up the value of these claims. And in particular, when it comes to the labor law, because it is, as Michael outlined, a statutory liability framework, meaning that an owner or a general contractor can be found in some cases absolutely liable for a labor law claim. What that allows personal injury attorneys to do is to file what's called a motion for summary judgment at an earlier junction in the case, or at an earlier juncture in the case. And under New York law in particular, and really again in other states, that allows the plaintiff to start collecting interest on the underlying judgment amount. So for example, if a personal injury claimant is seeking $100,000 and the court says that they are entitled to what's called summary judgment. From the time that the court makes that decision until such time as the claim ultimately settles, there is 9% interest clicking away on that $100,000. That's still better than you can get at any bank, even with interest rates rising. And so the exposures associated with these losses are extremely significant. And so the question becomes whether you are an owner or a general contractor or a subcontractor and you're participating in this webinar. We've outlined all of the substantial exposures associated with these kinds of claims. The question is, well, how do you manage it? And what we're going to do over the next few moments, over the next few minutes during this presentation, is talk about how you manage it. This isn't a question of risk elimination. Labor law, construction accident exposures are a relevant part of your business. And so the question becomes risk management. How do I manage these exposures to the most efficient ability, to my most efficient ability, so I can try to control my insurance premium costs? And really, principally, that has to do, and it starts with contracts. And what we're going to talk about is the function of risk transfer. And just to kind of give a general overview, all risk transfer really means is when you're starting out on a construction project, there's going to be a contract. And the question becomes, how are risks associated with that work? And for purposes of today, how are the risks associated with a construction site accident, a bodily injury claim? Let's say somebody gets hurt on that job site. How are we managing who is going to be responsible for paying for that loss? Who's going to be responsible for indemnifying the other parties to the contract? Who needs to bring insurance to the table? And whose insurance is going to respond in the event of a claim? And so there's two different avenues, general avenues or pathways that risk transfer really takes within those written agreements. So let's say, for example, you're the owner of a project site and you have a contract with a general contractor. Within that agreement, and many of you have probably seen these kinds of provisions before, there's going to be contractual indemnification provisions or a clause that says that you, general contractor, have to indemnify the owner. And then there's also going to be separate language in the contract that talks about who's got to purchase what insurance. Now, really distilling this down to its pure essence, because a lot of this is dense, but remember, again, this is some of the most important work that you're going to do in the construction space, managing your risks. So it's very important to have as much of an understanding as you possibly can. Indemnification effectively means that we are transferring risk. In this case, let's say from the owner to the general contractor for accidents that happen on the job site. So for example, if a subcontractor's employee slips and falls on the job site and sustains an injury, or the subcontractor's employee gets hit on the head by an I-beam that falls from a crane, the question is, if that employee now files suit, who's going to be responsible for taking care of that lawsuit? Who's going to pay for the attorney's fees? And who's going to pay ultimately to settle the claim? And or if it goes to trial, who's going to pay for that judgment? So contractual indemnification is one of those provisions, and insurance procurement is the other. Now, contractual indemnification is really a direct agreement between the owner and the general contractor, or the general contractor and the subcontractor, in which case one is protecting the other. That's all it really means. So using the subcontractor example, a subcontractor signs up for a job. Let's say they're a plumber. The plumber says, I'm going to protect you, general contractor, or I'm going to indemnify you if, for example, one of my workers gets hurt on the job site. That's the basics, but it gets obviously more complicated because these are contracts, and lawyers like myself, we love to make things more complicated. So within indemnification, or within the indemnity wording in these agreements, you can really think of it as there being this big spectrum. There's a spectrum in terms of how broad these indemnification provisions can be and how limited they can be. In the broadest sense, you can have an indemnification provision, and subcontractors, you really need to be paying attention to this in addition to owners and GCs, but in particular subcontractors. If you're signing an agreement that says that I'm going to indemnify the owner and the general contractor for anything that arises out of my work, meaning any claim that arises out of my work in any way, shape, or form, that's precisely what you're agreeing to do. So for example, let's say one of your employees gets hurt on the job site, but it had nothing to do necessarily with your fault. Meaning, let's say one of your employees tripped and fell over a vacuum tube, and that vacuum tube did not belong to you. It wasn't part of your work. It belonged to some other subcontractor on the job site. technically speaking, in the broad form indemnity that you see here on the left-hand side of the column, you still have to pick up that loss because it's one of your employees who got hurt. And therefore, the claim arises out of your work, even though you didn't necessarily do anything negligent, even though you didn't necessarily do anything wrong within the contract. You've agreed to protect the owner and to protect the general contractor for those kinds of claims because it was your employee that got hurt. The next kind of indemnification that we see very often in construction contracts is what we like to call the intermediate form of indemnity. And this is a narrower one. This is a narrower form of indemnification that has a pretty important exception. And what it basically says is, yes, I, subcontractor, will agree to indemnify you, general contractor, or taking it one tier above, I, general contractor, agree to indemnify you, owner, for anything arising out of my work, unless you, owner, or you, general contractor, are solely responsible for the particular loss. And a perfect example that we always like to use for this is, let's go back to the example of a subcontractor's employee. If a subcontractor's employee slips and falls on black ice on a job site, and it's the general contractor's responsibility to take care of de-icing and site conditions, if that's their exclusive sole responsibility under the contract, then really, technically speaking, the subcontractor is not at fault. And so if the subcontractor agreed to indemnify the general contractor for everything except for the general contractor's negligence, in this case, the indemnity provision does not get triggered, and the subcontractor has no obligation to indemnify the general contractor. But really, kind of just bringing this down to brass tacks, what this basically means is, so long as the party that is being indemnified is completely free from negligence, meaning they have to be absolutely 100% solely responsible for that claim, solely responsible for that loss, they're good to go. Practically speaking, in most instances, it's going to be difficult to prove that the general contractor or the owner is 100% responsible for the claim. And so therefore, in most instances, the indemnity is going to get triggered. The last form of indemnification, and the one that is probably the rarest, is where you have a limited form of indemnity that only gets triggered to the extent of the party that is indemnifying, to the extent of their negligence. Meaning, if the subcontractor is 55% responsible for the accident or 55% negligent, they only have to indemnify the general contractor and the owner for 55% of the claim. The truth is, especially in the state of New York, it's very difficult for an owner or general contractor to accept this kind of indemnification. Why? Because as Michael alluded to before, the labor law imposes strict 100% liability on the owner and the general contractor, which means no matter whether they're liable or not, they've got to eat the whole meal. So more often than not, a subcontractor is going to have to provide for some form of indemnification that's in the intermediate space, or some kind of broader indemnification that effectively renders them responsible for most kinds of accidents that happen on the job site. And the reason why this is the rationale is, number one, you have the labor law, which imposes strict liability. But number two, the subcontractor is typically in control of its own means and methods. And so the argument goes, since you're in control of your own means and methods, you should have to protect me for anything that arises out of those means and methods. But again, the most important practice tip here is the devil is in the details. Whether you're the owner, the general contractor, or the subcontractor, understanding upfront how much responsibility you're taking within these indemnity provisions for a construction site accident is critical, because, and we're going to talk about this in a second, these indemnity provisions roll into the insurance that you're going to bring to the job site. If you're a general contractor and you're agreeing to indemnify the owner, you got to make sure that you got good insurance that's going to protect you and that's going to take care of these indemnity obligations. So we talked a bunch about what indemnity is and how indemnity operates as a form of risk transfer. Now we're going to talk a bit about the separate track for risk transfer, which is called additional insured coverage and insurance procurement. Okay, so 50,000 foot view, we've got indemnity provisions that are built into a contract, and separately from that, we've got provisions within the contract that say, General contractor is going to bring certain forms of insurance to the job site with particulars, and we'll talk about these in a few moments, with specific kinds of insurance and specific terms of insurance and limits that they're going to need to bring to make sure that everybody is protected for all of that work. And the simplest example of this is the owner is going to say, contractor, you've got to bring general liability insurance to the project site that's going to provide $2 million worth of coverage, and you're going to name me as the owner an additional insured. We'll talk about what additional insured means in a few moments, but that's it in its basic essence. It's one party, in this case, the general contractor, saying to the owner or the other party, I'm going to get some insurance, and that insurance is going to protect against claims on the job site, both for you and for me. And these are some of the kinds of insurance that you're going to see included within the contract. You always have to specify. If you're the GC, if you're the owner, if you're the subcontractor, you want to make sure that the required insurances are specific or as specific as possible. You want to make sure that you're bringing workers' comp to the table, commercial general liability insurance, auto, if there are going to be autos involved in the work, and of course, excess insurance. Those are kind of the insurances that you see constantly being brought to these kinds of contracts, being included in these contracts, and always subject to a specific limit. As Michael said before, it's probably going to say you're going to bring a commercial general liability insurance policy to the project with $2 million worth of limits. All of that is the good stuff that you're going to want to see. And it's additionally going to say you're going to include me as an additional insured, me here being probably the owner or the general contractor. And so one important practice tip that you need to keep in mind, we just talked about the key ingredients in the insurance requirements. What you really need to see is that it's never enough to just say, I'm going to purchase insurance. The more specific it is, the better off that you're going to be. Specify upfront what the party's expectations are. And to trigger this additional insured coverage, it needs to specifically say that. The contract has to say, I am going to include you. Let's say, again, subcontractor. The subcontractor is going to say in the agreement, I hereby agree to include you as an additional insured on my insurance. If that's not there, you're not going to get coverage for the general contractor. You're not going to get coverage for the owner. That is a key prerequisite to ever triggering additional insured coverage. So what's additional insured coverage? Well, additional insured coverage is essentially a form of insurance that is built into your insurance policy that gives insured protection, insured status to somebody else. So let's say Josh Weisberg has a company and he decides to enter into a contract with Michael Fleischer to provide Michael with widgets. Michael's going to say, I want you to go out and buy some insurance, and I want you to include me as an additional insured on your insurance policies. So what am I going to do? I'm going to go back to my insurance company. I'm going to say, hey, Michael wants to be included as an insured on my insurance program. And hopefully my insurance company is going to say, sure, no problem. So what it essentially means is, in addition to you being an insured under your own insurance policies, now somebody else, somebody additional, is also included as an insured on your insurance program, an additional insured. As a general rule, the additional insured is entitled to essentially the same form of protection that the named insured is entitled to. That means that Michael and I have, for all intents and purposes, the same rights to coverage, the same rights to insurance protection under my insurance policy. But as always, the devil is going to be in the details. Not all insurance companies and not all additional insured language in a liability policy is 100% unique. And specifically in the world of general liability insurance, which is the kind of insurance that deals with labor law claims every day, all day. It's the kind of insurance that protects you for lawsuits related to bodily injury, a trip and fall, a slip and fall. That's the meat and potatoes insurance that we're dealing with here. There are different kinds of additional insured wording that you need to pay close attention to. Most of the time in a contract, again, let's use the subcontractor example because it's the best kind. Subcontractor enters into an agreement with the GC. The GC is going to say, I want you to give me additional insured coverage, either under what's called an 1185 endorsement to the policy or a 2010-0704 endorsement to the policy. The numbers don't matter. What matters the most is The 1185 that I'm talking about relates to, I apologize, relates to arising out of language. All that means is you're giving really broad protection to the additional insured. So for example, going back to Michael and Josh and their business contract, I'm basically telling Michael, I'm going to give you coverage for anything that in any way, shape, or form has some kind of nexus, some kind of connection to my work. It doesn't matter if Michael screwed up. It doesn't matter if Michael took my widget and decided to put all sorts of enhancements into it. He decided to put on some cool paint. He thought it'd be a great idea to put in some kind of alarm system on the widget. None of it matters. Even if that alarm system ends up causing the claim down the road, as long as it's my widget, it arises out of my work, which means he's going to get protection under my insurance for any claim that emanates out of that work down the road. There is a more restrictive form of additional insured coverage that's more recent or more modern, that is built out of the ISO CG 2010-0704 wording and similar wording. We'll talk about that. I'm going to show you what that wording looks like in a few seconds, but the critical distinction here is it's a little bit narrower. And what this basically says is what this more narrow version says is if Michael is the reason why the claim happened, if Michael is, for all intents and purposes, his alarm system is what caused the loss, in that case only, he doesn't get additional insured protection under my insurance policies. And that makes sense to a degree, right? The idea being that, yes, Michael should be entitled to additional insured coverage, but should he be entitled to additional insured coverage if his negligence, if his fault is the reason why the claim happened? So what you're starting to see, and this is really a product of some of the labor law exposures that Michael was talking about earlier, insurance companies have decided to take a more narrow view of what's covered. They don't want to cover additional insureds for everything arising out of the sun, especially if the claim was the additional insured's fault. In that instance, it really should belong, the claim should belong on the additional insured's policy, in this case, on Michael's policy. And so, we're all about show and tell here. There's a separate additional feature to the more modern additional insured endorsements that you need to be careful about. So subcontractors, you're working on a contract and the general contractor says, I want you to give me coverage for what's called my ongoing operations and my completed operations. In the world of insurance, those are two totally separate things. And that means that you need to get two totally separate kinds of that are built into your insurance program. You're going to get one that's going to cover you for all your ongoing operations. And that basically means you're sitting there and you're banging away using a hammer. That's good. You're going to get coverage under one kind of insurance endorsement to your policy. Separately from that, you're going to get what you see up on the screen here right now, which is called a completed operations endorsement to your additional insurance. And what that effectively means is, after my work is done, if somehow or another it causes an accident later on down the road, I'm going to be able to give additional insured coverage to Michael. So let's say I completely assemble that widget, I give it to Michael, Michael sells it to his customer, and it blows up 2 years from now. The completed operations endorsement, this endorsement or this language that gives you coverage for stuff that happens later on, you need to have this on your policies on a going forward basis, because otherwise you will not be able to afford additional insured protection. And remember, your contract says, I'm going to give Michael coverage for my ongoing operations, my jackhammer operations, and then also after all the widgets are sold 2 years from now, I still need to give him coverage if a claim arises out of everything that I've finished. So you're going to be giving him two endorsements, one for the ongoing operations and one for the completed operations. And this is all, again, part of that broader risk transfer mechanism that's called insurance procurement. All the things that you need to bring to the table in your own insurance to make sure that you're complying with your contractual requirements to give insurance to the parties that you're doing business with. So we bring it all back to center. How are we going to make sure that we've got the right insurance procurement language in our contracts and that our policies are going to respond in the event of a claim? Number one, there's always got to be a written contract. There's no insurance company in the world that's going to allow anybody to be an additional insured. There is no insurance company in the world that's going to allow anybody to take insured status under their policy as an additional insured unless there is a contract, a written contract that says A agrees to name B as an additional insured. If that's not in there, if it's not in writing, B is 100% out of luck. That's just the way that it is. You also have to be specific. You have to say additional insured for this kind of insurance, subject to these kinds of terms, and for how much money worth of insurance you need. And then ultimately, on a factual basis, you're going to have to show that somehow or another, the underlying claim was caused by the work of the party that's giving additional insured protection. So meaning, again, it has to be, in my case, that my work caused the claim that Michael is now looking for additional insured protection to protect himself against. If that's not there, my insurance company is not going to protect him. And last, and definitely extremely critical, your insurance policies, whether you're the general contractor, whether you are the subcontractor, cannot contain any other provisions that would knock the claim out of the box. What does that mean? That means, let's say I've got a great contract. It's gorgeous. It's beautiful. It says, I'm going to give additional insured protection to Michael. I'm going to give him $2 million worth of coverage. It's all there. The claim was caused by my work. But what if there's a separate provision within the policy that says we don't give coverage or we exclude coverage for defective products? Any claim arising out of a defective widget, we're not going to cover. In the labor law context, that takes on the form of what's called action over exclusions. And these are a red button issue in the insurance industry. It's something that you need to be paying very close attention to. If you're a subcontractor and you're agreeing to give coverage for all these kinds of work, if your policy says, I'm not going to cover anybody, meaning I'm not covering you, subcontractor, I'm not covering general contractor, or I'm not covering owner for any claim that arises out of injury to my subcontract, to one of my employees, to the subcontractor's employees, you've got a problem on your hands. Why? Let's say there's a labor law claim. I'm ABC subcontractor. One of my employees gets hurt on the job site. I've got a good insurance policy. I've got good contractual language that requires me to name the GC as an additional insured. But separately, my policy says that you're still not entitled to coverage because there's an exclusion on there that says, we don't cover any claims for anyone for injury to one of your workers. And this claim arises out of injury to one of the subcontractor's workers. And since it arises out of the subcontractor worker, no coverage, no additional insured protection for the owner, the GC, and no insured protection for you as ABC subcontractor. And so for all intents and purposes, you're now in breach of your obligations under your contract to provide insurance protection to the general contractor and the owner. And there is no coverage in force for what could be a very significant labor law claim. Setting aside the fact that there's a contractual breach, of course, this could leave you without any insurance protection whatsoever for any claims made by that owner or that general contractor. And that leaves you with a potentially uninsured loss. So you need to be paying very close attention to a number of different things. What does this contract require me to bring to the table in terms of insurance? Do I have the right additional insured endorsements or wording on my policy to comply with those requirements? And are there any other endorsements or exclusions that are embedded or hidden in my policy that might knock out all of these claims, even if everything else is right? Even if everything else is perfect and we've got beautiful additional insured coverage, you may still not have coverage for the claim down the road. And so you need to really pay attention to what your insurance policies specifically provide in terms of protection. A couple of other corollary points that are very, very important. In many instances, multiple different subcontractors are going to have potentially implicated insurance. In many instances involving claims, you're also going to have an insurance policy that belongs to the general contractor that might ride tandem with the subcontractor. More often than not, in that situation where you've got one policy that covers a claim and another policy that covers a claim, both insurance companies sit at the table. Imagine you're at a restaurant, both are pointing fingers at one another saying, who's picking up the check? Well, in the world of insurance, that's handled by what's called other insurance endorsements or other insurance conditions to the insurance contracts. So the general contractor, let's just use an example of a subcontractor's employee, again, gets hit on the head by an I-beam. The general contractor's insurance policies, if they're written the right way, are going to say, my insurance goes last. You subcontractor, your insurance needs to go first. But the only way that that all gets matched up is if within the contract itself, between the owner and the general contractor, it specifically says subcontractors' policies need to go first. It's what's called primary and non-contributory. If that contract says subcontractors' policies need to go first, then that will satisfy, for all intents and purposes, and in most cases, that will satisfy the wording in both the subcontractors' policies and the general contractors' policies, and everyone will agree that subcontractors' policies take pole position, they come first, and then the general contractors' policies, if they're needed, they come in secondary, they come in after the subcontractors. And from a subcontractor's perspective, from a general contractor's perspective, this is super important. This is important stuff, because if you're agreeing at the front end of a job that you're going to allocate insurance or allocate insurance exposure to one party, you want to make sure that that intent flows all the way through. It should flow through the contracts, ultimately into the insurance policies, and that leads to quicker resolution of claims. Everybody understands there's one party that needs to pick up the tab for this particular loss, as opposed to everybody fighting over who's going to pay what as the claim continues to progress. And guess what? While they're all fighting, the plaintiff is undergoing more surgery, the plaintiff is undergoing more treatment, and the claim becomes only more and more expensive to resolve. So this is just another example of how getting those contracts right and getting those policies right will lead to a much, much cleaner resolution. As you can just see here, this is again all about show and tell. This provision that you see is effectively that requirement built into the insurance policy. And what it basically says is, me, subcontractor, my insurance policies are always going to apply. However, in circumstances where, for example, the general contractor is an additional insured on my subcontractor policy, my policies go first, and the general contractors are excess. So just quickly summing it up before we move on to a couple of smaller topics or a couple of smaller housekeeping items, what do you want to do? You want to have your contract explicitly state who's bringing what insurance to the table, the kind of insurance, the limits of insurance, the right additional insured endorsements, the right wording that says whose policies are going to pick up first, and no bad exclusions. Meaning you could set it all up right, you could do it beautifully, and if you've got, again, an action over exclusion on your policy, you're not going to have coverage for anything. And this is the basic framework that's used for risk transfer in construction contracts throughout the state of New York, and really honestly, throughout the US as well. This is the general framework that is typically used in order to allocate risk. There are a couple of different wrinkles that get built into this as well. I wanted to talk just for a few seconds about wrap insurance programs. The difference between a wrap insurance program, and many of you, especially subcontractors, you may be asked to participate in wraps. The difference is you're not bringing your own insurance to the table. What's happening here is the owner or the general contractor is sponsoring insurance for everybody. And the reason why they do this is it makes it easier to avoid all of these questions related to risk transfer and contractual indemnification and insurance procurement. The owner, the contractor, or the general contractor effectively says, I'll pick up all the insurance, I'll bill you back for it, but I'll pick up all the insurance. And in that way, we don't have to worry about indemnification and insurance procurement as much. It makes life a lot easier. But a little pro tip, if you are going to be involved in a wrap, there are other wrinkles that come into play, different permutations, so that if you're a general contractor or a subcontractor, you need to know what that means for purposes of risk transfer. Risk transfer isn't totally gone. It just takes on a different shape. That's a much more complicated conversation, and it's something that we would really have to develop through wider conversations offline. But if you have any questions, of course, about wraps that you're participating in and the contracts you're being asked to sign, definitely bring that up, and we'll be happy to answer all of that for you. A couple other quick points. Michael mentioned this before, certificates of insurance. When you are bidding a job, or when you, as a general contractor or or a subcontractor, you're going to be asked to provide a certificate of insurance. Owner, general contractor, subcontractor, it doesn't matter who you are and your role in participating in this webinar. Keep in mind, the certificate of insurance is a piece of information. That's all it is. It's not the insurance policy. It doesn't bind the insurance company. It doesn't foreclose an insurance company from denying a claim. The best practice that you should always have is having conversations with your insurance consultants, your risk managers, and your brokers. What does my policy actually say? You should never be relying, ever be relying on a certificate of insurance to confirm coverage. So for example, general contractor, if you're vetting a sub and they give you a certificate of insurance, well, that's great. But you got to look at those policies, because the policy might have one of those nasty action over exclusions that we were talking about before. And that is not going to be contained anywhere in this document. They will not tell you that there's an action over exclusion. So just keep that in mind. Now, we're going to sum it all up. We're talking about risk transfer. We're talking about how important it is. We're talking about clear expectations as to who's going to handle all of these substantial exposures related to labor law and construction accidents, and what that means for a job and what it means for your insurance program. Keep in mind, there's two forms. There's contractual indemnity and there's additional insured coverage. They never go hand in hand. They're not synonymous. Contractual indemnification, brass tacks, it's not going to get triggered immediately upon notice of a claim. What carriers or insurance companies usually do is they wait until the end on contractual indemnification to decide whether or not there's an obligation to indemnify. So if you're a general contractor and you start screaming at the subcontractors, insurance companies, I want to be indemnified, look at my contract, invariably what they're going to tell you is, you got to wait. I got to make sure that my subcontractor's work is what either caused and or that the claim arose out of my subcontractor's operations. And I need to see whether or not you, general contractor and or owner, were affirmatively responsible for also having caused the claim. Those kind of parameters or variables will always delay acceptance of indemnification, or more often than not, delay acceptance of indemnification. Additional insured status is different because the additional insured is a party to the actual insurance contract. And since they're a party to the actual insurance contract, the insurance company has an obligation up front to begin defending, to potentially indemnify the additional insured even before liability is determined. Meaning they got to start stroking checks to the law firm and to the vendors that are going to be associated with defending that labor law claim before liability is even determined. Those are the critical distinctions between indemnity and additional insured coverage, between indemnity and requirements to buy insurance. But you have to understand that you need both. You're never going to have just contractual indemnity or just insurance procurement language. You need them both to make sure that you're hitting every single different angle, because there could be circumstances where you're not entitled to additional insured coverage for whatever reason, in which case you're going to be able to fall back on contractual indemnification and vice versa. Just a quick example so that we can take on any questions. Let's say that the subcontractor's policy had an action over exclusion, and so there's no coverage under that policy. Well, you as the general contractor, the owner, can still rely on contractual indemnification. That's not gone. It's still there. And so you can seek direct indemnification from the subcontractor, even if there's no insurance for the claim. I want to thank everybody. I really appreciate your time, as does Michael. These are obviously very complex, very dense questions, but they are so important. And the more that you understand about how these contracts are drafted and how the insurance policies respond, again, the better positioned you're going to be to manage the risk for this very, very real and very substantial exposure. Thank you. There are a couple of questions. So one of them is for me. What happens if more than one insurer involved has a primary non-contributory endorsement? Good question. There can be circumstances where you have multiple insurance companies that all have a potential obligation to participate in a loss. Usually, if they all kind of mat up against one another, meaning that they're all co-equal, that each insurance company is going to participate on what we call a pro rata basis or on a 50-50 basis. That's usually, if it's done the right way, that's not the outcome. What's going to end up happening is someone, usually the general contractor or the owner, is going to have better insurance language or better priority language, which will mean that the subcontractors' policies need to respond first. But if the language if the language doesn't provide for that, then they usually go 50-50. There's another question. What happens if, and again on the same topic, what happens if there's one policy has a particular kind of primary non-contributory endorsement, and another policy has other wording? That can happen sometimes. So for example, you could have two policies that both say that we are excess, meaning again, you're at the table and both insurance companies have policies that say, I don't have to pick up the check. Again, in that scenario, those are what's called conflicting other insurance conditions. And in that situation, both carriers will have to contribute on an equal basis to whatever the claim may be. But again, that's the exception. That's not the rule. That seems to be it. Okay, as Kellyanne mentioned, our contact information is here. Any questions that you have at all about contract drafting or insurance procurement, by all means, please contact Michael. You can contact myself. We're more than happy to help. And we thank you for participating today.
Yes,
Thank you, Michael and Josh. That was really informative and a great amount of information. We will be providing a recording as well as a copy of the PowerPoint to everybody who's attended, so that you can have all of this great material. Our host, Cerini and Associates, will be hosting two webinars, one on October 5th, and that'll be on automating your internal functions, and one on November 14th, and that'll be about the new pay transparency laws in New York and how to retain employees now that that information is public if you can't pay that same amount as other places. To learn more about these webinars, visit www.cerinicpa.com. Thank you, everybody, and we look forward to seeing you soon. And again, thanks, Mike and Josh.
Thank you.